I'm excited to welcome you to tonight's Backgrounding and Stocker Profitability Conference. Session 3, Managing and Protecting Your Profit. Our speakers tonight will cover tax and financial management, livestock risk protection insurance, and discussing our current market environment. Tonight's webinar is funded by the Kentucky Agriculture Development Fund through the Kentucky Beef Network. My name is Becky Thompson, and I will be your moderator again this evening. Tonight's session is being recorded, and all session registrants will receive an email next week with a copy of the presentations, the recordings of all sessions, as well as all resources that we have referenced throughout the week. There will also be evaluations emailed to you from all 3 sessions, and we really appreciate your feedback so that we can make improvements to future webinars as well as this conference. At any point throughout the webinar, you can ask a question through the Q&A button at the bottom of your screen. We will be compiling the questions and answering them at the end of every presentation. At this time, I would like to turn this over to Jonathan to begin our program. Jonathan?
All right, thank you very much. You can see my slides, Becky? Fantastic.
They look good.
Thank you. Yes, so great to be here with you all tonight. I am Jonathan Shepard. I will be talking to you about some tax and financial management stuff that is relevant to backgrounding and stocker operations and also just agriculture in general. So as economists, we have been, preaching to you now, going on the 3rd night about all different aspects of financial considerations, budgeting, so on and so forth. And I'd just like to remind everyone that, agriculture is inherently risky, and we have risk that we have to contend with in, at least 5 different areas: marketing, production, legal, and personal risk. And tonight I'm going to talk more about ways to shore up the financial side, things that we can do, things that we can think about, approaches that we can take to help out our operations financially speaking. So you've already seen in the previous nights talking about budgeting, understanding, cost of gain, value of gain, those kind of things. So what I want to focus on for the first part of this presentation is cash flow budgeting. So enterprise budgeting would kind of capture, some of the budgeting that we've looked at with us yesterday and then last night and the night before. And whole farm budgeting is where we kind of, compile everything together, look at the farm globally if we are dealing with more than one enterprise or more than one income generating stream. But cash flow budgeting is an area where I feel like, anecdotally at least, that farmers struggle to complete cash flow budgeting. So I want to present it in a very simplistic way, just to get your head wrapped around how to think about cash flow budgeting, what it means, and then more importantly, what can we do if we are faced in a situation, we're facing a situation where we have some cash flow issues where liquidity is tight. So the most basic, well, first let me say that cash flow budgeting, we are dealing with liquidity. And just to make sure that we're all on the same page, when I say liquidity, I'm talking about, how much income, or more specifically and more accurately, how much cash do you have on hand or coming into the operation over the next 12 months to pay the bills that you have to pay, operating expenses, debt payments, all that, living expenses, so on and so forth. So when we talk about cash flow budgeting, we're talking about all cash in and cash out of the operation, not just revenue and expenses. And it does not necessarily or at all equate to profitability. So it's entirely possible to have a cash flow issue from time to time and be a profitable business. Where it is related to profitability is in the context that if you're not a profitable operation, you will have cash flow issues eventually. So just try not to conflate the two, but understand that one leads to the other. So timing is present when we talk about cash flow budgeting, and the simplest way to illustrate cash flow budgeting is just with these three boxes here. So you've got all the sources of cash. So you've got what you're selling, your cattle, anything else that you're selling off the farm, government payments, things like that, as well as loan sources, all as your sources of cash. They're going to run through, some kind of bank account, checking account, and then they come out as uses of cash, going to pay principal and interest, buying things for the farm, expenses, living expenses, so on and so forth. So when I say timing is important, like I said on the previous slide, you can break cash flow budgeting down into infinite time periods, really, but typically, a monthly basis or a quarterly basis. The way I'm showing it here, think of this more as on an annual basis. Which is the best way to do it? It all depends on what you need in your operation. There's certainly nothing wrong with doing a monthly cash flow so that you can understand, when the money's coming in and the months that you're going to be short. But there's plenty of pre-existing cash flow budgeting tools that exist out there from various universities, and the complexity and the level of detail varies. So I just encourage you that if this is something that you want to do, like in an Excel spreadsheet or something, to go do a little internet searching, and you'll probably be surprised at the number of cash flow budget templates that already exist out there for you. Once again, though, I'm just kind of speaking of this on an annual basis or from a tax year perspective. So we want that blue box, the sources of cash, of course, to be bigger than the uses of cash. And what we don't want is this situation here, where all of our uses of cash far exceed our sources of cash, because this is a problem. And this is how we get cash flow problems, or we have liquidity issues. This is where you start struggling being able to pay bills, pay feed bills, things like that, running late on principal payments and interest payments. So this is what we want to try to avoid. And with a cash flow budget, once again, we should be able to, put that down on paper or put that in an Excel spreadsheet and project what our income and our expenses are going to be on a monthly basis, quarterly basis, and identify when we're going to have those liquidity issues. But most importantly, we want to look at it to see if we're making, if we're going to be able to pay the bills for the year. And we literally could spend 3 nights just on cash flow budgeting, all the ins and outs. It would be really boring and terrible, but we could do that sometime. But what a lot of people want to know is, how do I handle these liquidity issues that I am facing and may be facing? So if I find myself not having enough cash reserves, are there things that I can do, or what is the suggestion of areas to look at in order to address those issues? And so I've just listed 4 areas here: restructuring, debt, or credit balancing, depending on what terminology you like, slowing expansion in the operation, reducing operating expenses or cutting costs, and then last but not least would be liquidating assets. We're going to walk through each of these in a little more detail. When I talk about restructuring debt or credit balancing, I'm talking about it in the terms of your total debt being comprised of, at a minimum, 2 categories of debt: your current debt and your intermediate term debt. Sorry, I had to find my digital pointer here. So at the bare minimum, your debt typically, assuming that you have operating money, is there's going to be a current portion, and then in some cases, people lump these together, intermediate and long term, just as non-current debt. So at a bare minimum, there's going to be two categories for most business owners. But if you're staying consistent with the way in which we have a tendency to do balance sheets, we break that that non-current debt into two categories, intermediate and long term. So what we typically see happening is our current debt gets out of control or balloons or is a bigger portion of our total debt picture than maybe our non-current or intermediate or long term. And it's important for me to point out that I don't mean that it dollar-wise is necessarily bigger, but servicing that debt is a real strain on the operation. So let's say, for example, that your operating note, you're having trouble paying off your operating note every year, and you don't have market animals to be sold in such quantity that would pay that operating note off. That's what we call frozen operating money or frozen capital there. And instead of being faced with the scenario of, okay, I've got unpaid operating money that I can't pay back, and having that riding on your current financial situation, maybe depending on the specifics of your operation, maybe we take that operating money and term it out over a longer period of time. So, for example, let's say that I had a $250,000 operating line of credit, and I've got $50,000 sitting out there that I can't pay back. Instead of having that $50,000 out there accruing interest, and the bank wanting it paid, maybe I stretch that out over 5 years or 10 years, or maybe I roll it in with something else and stretch it out over a longer period of time. And that relieves my cash demands in the short run, lowers my payment or what the bank is expecting me to pay, and gives me a little bit of breathing room, for lack of better terms. Now, before you consider restructuring debt, there are some warnings that I give everyone all the time. First, you need to identify why you had this debt imbalance to begin with. So why do you have operating money that you can't pay back? We first have to identify what that management issue is. And sometimes I use that terminology and people get somewhat offended. I'm not saying that you are a bad manager or you're a bad business owner if you get into one of these situations. It's not a shame game. It's not, you're stupid and you did not do that. But we need to understand why that happened. Maybe it was something that you did. Maybe it was something that you didn't do. Maybe it had nothing to do with you at all. But just identifying how that occurred will keep us hopefully from, having it happen again in the future. The other thing that we see a lot of when it comes to operating money is that people will use it for purposes other than operating. So they'll use it for things like purchasing equipment. If you've used your operating note for that purpose, by all means, it makes sense to refinance a portion of that and put that on the term note as it should be in order to make it cash flow better. If it is just frozen capital there, frozen operating money that is from operating shortfall, you have to assess your equity position in the business. Do you have equity which to collateralize that unpaid portion of the operating note? That can be an impediment to refinancing that and stretching it out. The refinancing absolutely can help improve your cash flow. It potentially can save you on interest. And so I encourage everyone to have a conversation with your lender if you find yourself in that situation. The other thing that happens sometimes that I have noticed, anecdotally speaking, is that we get ourselves in a situation where we can't pay back the operating note, and then we get concerned or we feel bad about it. And we are embarrassed or afraid of what the lender may tell us if we go visit them. And, I'm not here, on behalf of any lender, but I can tell you just from my experience as a farm management specialist working with farmers, Lenders are typically interested in having that conversation and interested in helping you find a solution. And the sooner you find a solution to that problem, as opposed to ignoring it, the better the results are typically for you as the lender, and as the lendee and as the lender. If it's just a short-term situation where you've identified what the problem is, maybe you got a note that you can't pay back, but on time, but you will be able to catch that up. Interest-only payments sometimes are an option as well. That's all going to depend on the structure of the debt, how far you are into the debt. That in some situations, if you're early in the loan, like a mortgage payment or something, an interest-only payment may not save you a whole lot compared to actually making the whole payment. So those are all just some things to consider when it comes to credit balancing or restructuring debt. When it comes to slowing expansion of the operation, there are two things to think about. So if liquidity is tight, slowing expansion will help ease the liquidity squeeze, so to speak. So expanding, means not only going out and buying farms or renting more land or more pasture or whatever the case may be, but that expansion also means expanding a herd, for example. So if you're going into a situation with a liquidity squeeze already, and you're looking at maybe backgrounding more animals, for example, in the upcoming year, maybe now is not the time to do that, because most likely expanding your current operation is going to put a further tightening on the liquidity position that you find yourself in. Regarding reducing operating expenses or cutting costs, I would argue that most, if not all, ag producers are already operating at the point of lowest cost, or they think that they are. And so I encourage people to think outside of the box when it comes to this, when it comes to actually trying to reduce cost further. We are all guilty of operating in a certain form or fashion. We do things the way we do things. It doesn't mean that we're tone deaf to suggestions or that we are not willing to listen to other people's suggestions, but we just have a way about doing our business. And that's what I mean by, we think that we're operating as efficiently as possible. So, but you can take somebody from a different farm operation and have them look at your operation. They can probably pick out some areas where maybe you could be even more efficient, and vice versa. And so one area that I see this in is with labor, especially with hired labor. It's important to evaluate all that hired labor that we have and ensure that we are getting the value that we need to out of that hired labor, especially whenever it comes to H-2A workers, folks that come here under the guest worker program. Sometimes we have a tendency to bring in, X number of H-2A workers, and maybe we could get by with bringing in, fewer. So that's what I mean by think outside of the box. Really challenge yourself to really look at the way in which that you're operating. Challenge yourself, and is there a more efficient way to go about doing X, Y, or Z? And then the last bullet point there, risk versus reward. It's important to keep that in mind as well, because as the old adage says, we don't want to cut our nose off in spite of our face. And that's important as well. So sometimes it's a real balancing act. Maybe I can get rid of one of my hired hands, but what risk is that going to be? Is it's the money I save going to outweigh the potential risk that I'm taking on, so on and so forth. There are no real easy answers in any of this, but there are things to think about. The last but not least is liquidating assets. And I always warn everyone to be wary of liquidating income producing assets. And there are certain areas, and so first of all, let me say what do I mean by income producing assets. These are the assets that, as the name implies, you are using to produce income. So arguably equipment is income producing assets. If you were talking cow-calf operation, then breeding livestock would be income producing assets. And I'm actually going to use a dairy farm example here to explain what I mean by the death spiral, but this is not solely, this doesn't solely happen on dairy farms, but it's an easy example to use. Excuse me. What I mean by the death spiral is, think about a dairy farm that has an operating loan shortfall for a given year, where they can't pay a feed bill or something like that. And so what they do is they decide they're going to sell some cows this year to pay that feed bill that they can't pay. I'm not talking about cull cows that are, a normal part of the operation, selling animals in excess of what they normally would do to come up with some cash to pay that. Well, you've automatically reduced the income potential in the future time period by doing that. And what I would see with some dairy farms sometimes is that would happen 2 or 3 years in a row, and before you know it, we've lost 15, 20 cows. And so that's what I mean by that death spiral. So be careful of that with income producing assets. It's entirely possible that maybe you're overcapitalized in some areas, and you can absolutely afford to get rid of some equipment or something like that. That's really not going to impact your ability to produce income in the future years. But you also have to be aware of the potential tax consequences of that as well. Oftentimes with equipment, unless you've taken some accelerated depreciation or something like that in the past, it's not going to be too big of a deal for most folks. But if you get in a situation where you're selling land or something like that, especially land that you've owned or inherited for quite a while, the tax consequences of that can be pretty significant. Also, whenever you're analyzing expenses, I encourage you to analyze all expenses, and that's why I've got family living and expenses and owner withdrawals in red there. It is surprising the amount of money that it takes just to live, and I mean, I'm even surprised myself. And as we all know, living in a period of inflation with fuel prices and food prices going up, the draws from the operation or from the business to family living reasons or upkeep, so on and so forth, are higher. So that is an area where, maybe there are some opportunities to reduce some expenditures and help solve a liquidity problem. This is also just part of the where does the net farm income go to mystery. So if you're looking at your income statement, for example, and it says that you made X number of dollars last year, and you're scratching your head trying to figure out where those X number of dollars found a home, they're living in one of 4 of those categories there that you see. That's literally the only 4 places that your farm income can go. So you either ate it, used it to get yourself from point A to point B, or clothe yourself or entertain yourself. You paid taxes with it. You increased assets, or you decreased liabilities. And just my experience, both working with other farm families and working on my own financials, family living expenses oftentimes eat up a bigger chunk of that than what we're planning on doing. So that's a good area to look out for as well. So solvency. So now I've switched to solvency. This is really outside the cash flow budgeting talk, but I would be remiss if I didn't talk about solvency as well. Solvency is more of a longer term issue where you're looking at, what your total asset values are compared to your liabilities. And if you find yourself in a solvency crunch or a position where solvency is an issue for your operation, you really do have fewer options to deal with. Retaining more income is one of the suggestions, and sometimes that's not possible, but it may be possible to eliminate other enterprises within the operation that are not profitable. So retaining more income may mean getting rid of some other enterprise that you're engaged in. Really dealing with solvency issues, a lot of times we see the selling of assets being the solution. Once again, the same song and dance I gave you just 2 minutes ago on income producing assets applies here on the solvency side as well, and the tax implications are important as well. off-farm income, and really this, I really mean this as, off your farm income, meaning that, maybe you have the opportunity to do some custom work for other people, utilize your equipment more, your time more. That's not going to work for everybody. I get that. But, something to consider. And then, once again, think outside of the box on ways to make income from the farm. Are there other things that you could be engaged in on the farm in order to increase the income and helping pay towards debt? So that kind of wraps up the farm financial aspect of it in the truest sense. But now I want to talk to you all about some tax things, tax tips, if you will, but also it's, interrelated with farm financial decision making as well. So just to start out this conversation, I want to just remind you of a couple things that I feel like farmers forget about sometimes. And the first one is 1099s. Specifically, who gets a 1099? Let me first start with what is a 1099. In case you're not aware or have forgotten, a 1099 is an informational return that you as the person paying has to fill out and file with the Internal Revenue Service and provide a copy to the person that you've paid. Like I said, it's an informational return. It is you helping the government keep tabs on other people's income for them. I mean, point blank, that's what it is. But there's rules that we have to follow as business owners in order to be able to deduct these expenses that we incur. And then as you'll see here in a couple slides, there are some pretty significant penalties associated with not providing 1099s in a timely fashion as required by law. So any non-employee who you pay for services over $600 in a calendar year, you are to send them a 1099. This captures individuals, LLCs, and partnerships. Only subchapter S and subchapter C corporations are exempt from receiving 1099s. Within that subchapter S and subchapter C exemption, there are some further exemptions, i.e. lawyers and veterinarians, that are supposed to receive a 1099 regardless of their business entity status, assuming that you paid them $600 or more in a calendar year. So you hire someone to perform some service for you. How in the world do you know what business entity that they are? You probably don't, unless it says in the name. So, Joe Smith Fencing LLC. But a lot of times we don't know that. So there is a way in which we can obtain that information. That is with Form W-9, which of course is available through the Internal Revenue's website. And what a W-9 does is it forces the person that you're paying, or I shouldn't say force, but it puts the due diligence on them to provide you with all the information that you need so that you can be compliant with the 1099 law. So the Form W-9 will ask for them to put down their name, their federal, their FEIN or their TIN or their social security number, their legal name, and they will actually check a box as to whether or not they are taxed as an individual, an LLC, a partnership, a sub-S or sub-C corporation. And that gives you the proof that you need in case you ever get audited as to why you did or did not provide a 1099 to a particular person who was paid $600 or more for services in a calendar year. So one thing I will tell you that if you are going to request W-9s to be filled out by people providing services, your rate of return on those, meaning if you want to increase your chances of them actually filling it out, have them fill out that W-9 before you pay them. After they've been paid, sometimes they're not as willing to fill that out for you. So what are some of the things that, or some of the services for which 1099 is required? Things like rents, royalties, and prop share payments in some cases, interest payments, non-employment compensation, commission payments, fee payments to attorneys or other professional service providers, and veterinarians. That kind of captures the lion's share. So if you're renting a farm from somebody, you're going to need to send them a 1099. If you're hiring somebody to do contract labor on your farm, repairs, erecting fences, so on and so forth, they get a 1099. One exception to this is freight and trucking. Those two categories, freight, truck, and hauling, I guess three categories really are three different terms, is exempt. So if you hire someone to haul cattle for you to the stockyard or to a feed yard, that you don't have to send them a 1099 for the hauling charges associated with them. Veterinarians is one that catches people off guard a lot. The lawyer requirement has actually been around for quite some time, but the veterinarian one came about with the Affordable Care Act. It was part of the legislation associated with that bill that passed. And so, yeah, you are technically required to send your veterinarian a 1099 if they have performed vet services on your farm or on your animals in excess of $600 in a given calendar year. That does not include the cost of vaccinations or supplies, but just their services. If you talk to veterinarians and find out how many 1099s they're getting, it's still a pretty small number. There's not a lot of people complying with this, but it is the law, and it is one of those areas where if you get audited, you're likely going to get fined for not sending a 1099 to your veterinarian. Speaking of penalties, and this is one of the reasons I choose to talk about this with farmers, is because the failure to file penalties associated with 1099, of not filing 1099s, has gotten pretty steep. 2011, 2015, in that time period is when they really started ratcheting up failure to file penalties. But if you look there for 2021, so these would be 1099s that were due out, the end of January of this year. So, January 31st of 2022, the 2021 tax year. If you're up to 30 days late, it's a $50 per form penalty. If you're 31 days late through August 1st, it's $110. And then if you get past August 1st and fail to file a 1099 or don't file it at all, it's a $280 per form penalty. And when I say per form penalty, I mean it's literally per 1099 that you did not send out. So let's say that you get audited by the IRS and they're looking through your Schedule F and they're looking at your contract labor, custom hire category, and now they're looking at your bank account and they're looking at your rent category and they're looking at your bank account and they say, oh, you've got 10 different landlords. You did not send a 1099 to either of those landlords, and under the assumption that you paid $600 or more to each of those landlords. That's a $280 fine per 1099 that you did not fill out. So that, if you had 10 landlords, that's $2,800. Those fees start stacking up pretty quickly. Now, those fees are based off of a certain date and time, and then they charge penalties and interest on top of that. And if you're like, well, that's all right, I'll take a $5,000 penalty and roll on, I would like to point out to you that for small businesses, the cap on these penalties, interest, and late fees is $556,000. So the upper limit there is quite high if you have a lot of 1099s that you did not send out. They can really penalize you pretty hard. If they can prove intentional disregard, then it is $560 per form, or 10% of your income reported. That's 10% of not your net income, but 10% of your gross income, with no maximum on them. So be very wary of that, and make sure that you send out your 1099s, and so that you can avoid those penalties if you ever do get audited. This next slide here is mostly just a reminder dealing with market animal sales. So, and that's what backgrounding and stalker animals are market animals. So regardless if these animals are raised or purchased, they get reported on the Schedule F as ordinary income. So that's when we go up there and, lines 1 through 3 of the Schedule F in the top section there. These animals are subject, or this income, to be more specific, is subject to self-employment tax. And so that's, those of you in the business totally understand that. That's where they go. Why do I mention this? Breeding livestock are treated differently, different reporting, different taxes, but market animals, ordinary income, we got to pay that 15.3% self-employment tax on the net income. That's net ordinary. The thing that I see sometimes, especially in operations that are just starting out, is this cattle basis concept. And I'd just like to point out to people that, you cannot deduct the cost of any purchased market animals until the year in which they are sold. And, if you're buying market animals and putting weight on them and selling them in the same year or same tax year, not a problem. Where this becomes a problem is if you cross over into a different tax years. For example, let's say that maybe I'm going to feed some stockers, or I'm going to background some animals over the winter. And so I'm just making up time periods here, but assume that I buy, 50 head in October. I'm going to feed them till, February or March of the following year. I could not deduct the cost of those 50 animals that I purchased in October on my 2022 taxes. I'm going to have to wait and deduct that 50 head on my next year's taxes when I actually sell the animals. And like I said, I see this being a challenge on some taxes that I've looked at for people that are in the business of purchasing market animals and selling them in some later time period. Of course, the expenses that are associated with those animals, so the feed cost, the veterinary cost, the utility cost, are a direct line item deduction in the year in which they occur, regardless of the year of the sale. So it's just the actual purchase of the animal, what that animal cost. You cannot deduct it until you actually sell it. One other thing that is very specific to livestock operations and fits nicely with backgrounding in stocker operations is this Internal Revenue Code section 451G, which allows for a 1-year deferral of market animal sales. So you can defer for 1 year the income of certain livestock sold to weather-related conditions, assuming that those weather-related conditions were severe enough to meet the threshold and be federally recognized and declared eligible to receive federal assistance. So these are the natural disasters, the floods, the tornadoes, those kind of events that you get that federal declaration of emergency and you get that federal assistance level of devastation. You can actually defer the income from animals that you sold in excess of normal to the following tax year. You are not required to replace animals, none of that. You're just able to, we had a drought, we had a flood, whatever the case may be. I sold 50 more head than I normally would that are market animals. I'm not going to claim that on this year's taxes. I'm going to claim it on next year's taxes. In order to have this, just to kind of recap here, there's 4 conditions. Your primary business must be farming. Your accounting must be cash method, which is the lion's share of farmers. You must document that the sales would not have occurred in a quote normal year. So had it not been for this federal disaster, you would not have sold the animals. And you have to also be able to document that the weather-related disaster caused the sale of the livestock. And once again, it sounds like I'm beating a proverbial dead horse here, but this federal designation and eligible for assistance is important. And the reason is important because there's actually another Internal Revenue Code section 1033E that deals with breeding livestock that you don't have to have this threshold. So sometimes people get the two confused. But with market animals, you have to have that federally designated and eligible for assistance criteria met in order to exercise this. How do you make this election? You actually do it by simply including a statement with your tax return that includes the following information: your name, your address, your ID number, the fact that you're making a declaration under RC 451G, and then you provide evidence of the weather-related condition, how the sale was related to that. But you also have to provide the number of livestock and kind, the number of livestock, kind, and type that would have normally been sold. And the convention is 3 years, so you look back over 3 years. So hopefully you're keeping well enough records that you're able to show this. You show the total number of animals sold in the current year and the number sold due to the weather-related event. And then you go ahead and calculate the amount of income that you're deferring and disclose that on this as well. So here is an example of what one of these statements might look like. This comes out of the 2019 National Income Tax Workbook. And you can see on there at the top, it just states the things that it's supposed to, the name, address, taxpayer identification number, the explicit statement that you're postponing gain under IRC 453G, and then you tell the narrative that on such and such date, this occurred, flood, drought, whatever the case may be, and why how that affected your operation and why you're having to sell animals in excess of what you normally would, for the reason being that you've been negatively impacted by this weather. As you can see in the very last sentence of this example statement, the calculation is done here. Taxpayer sold 150 head of cattle on March 27, 2019. In the previous statement, we find that they would have normally sold only 100 head. Yeah, and so, sorry, I can't read to you. Sorry, would have sold 50 head. So at any rate, you have to declare, this is how many I sold, this is how many I would have sold, and this is the income that I'm declaring. So what are we trying to achieve whenever it comes to taxes in general? Sometimes there's a bit of you feel a bit of a push-pull between trying to balance your income tax liability with, trying to quote unquote make the bankers happy. If there's any bankers watching, I think you know what I mean. I don't mean negatively, but there are lending standards that we have to meet. You need to be a profitable business in order to be able to borrow money. And then there's also IRS hobby rules that we have to concern ourselves with. So most people want to minimize taxes. Banks typically want to see a positive Schedule F, or what they refer to as an adjusted Schedule F. An adjusted Schedule F is them taking your net profit off of your Schedule F and adding back in interest and depreciation expense. They want to see that number at least be positive. And then if you consider the IRS's standards on what is profitability, there is the IRS hobby versus business loss rules that say that you need 3 positive years of income out of the previous 5 consecutive. And we'll talk about those 9 areas of consideration here just in a few moments. So what if you're faced with the situation that you have a higher farm income than you want, and you want to try to manage that down? There's some different options here. Farm income averaging is one, and I'm going to walk you through a quick example of that just to show you how the mechanics of that work. We still have depreciation acceleration techniques or tools available to us, so Section 179 and bonus depreciation. Prepaid expenses is one of the easiest, in my opinion, ways to manage tax liability. So prepaid expenses, of course, being, take this year, for example. Let's assume that it looks like your 2022 tax year is going to be a good year, and you're going to have some money to offset, buying expenses, later in 2022 that you plan on using in 2023. Of course, you want to do that for business purposes, locking in availability or getting a discount or whatever the case may be. But that is an option. And then what people really are trying to do in a lot of cases is actually manage self-employment tax. That 15.3%, albeit half of it is a deduction that you get to use, but that 15.3% on farm income or self-employment income is a pretty tough bite for a lot of people. And so there are some options there to think through as well. Once again, that we could spend several hours just talking about the ins and outs of this, but it is possible to structure your business into different entities where you are renting assets from one entity to, from one entity to the other. For example, land, buildings, where you're paying a fair rental rate basically to yourself through a different entity, and that is taxed differently, or more specifically, you don't have to pay self-employment tax on rental income. So those are some things to think about if you're trying to manage higher farm incomes. If you're trying to manage lower farm incomes, excuse me, and what I mean by this is to try to make the negative not look so bad. There's some different options here as well. So slowing depreciation expenses is one option. And one way to do that is not to buy as many things that are depreciable. But another way to do that, if you are buying assets that are rational for your business and are needed, is to choose a different depreciation method. So instead of using a 5-year 200% declining balance method, assuming it's a new tractor, for example, you could switch to a different depreciation method and use straight line. And so if you slow those depreciation expenses down on your tax return, that's going to help improve the bottom line. The other thing that I would argue to think about is consider depreciating, quote, other things. So things like lime, for example, if you have pasture that you're liming, while lime is an expense that you can take off all at once, it does meet the definition of having multiple years of use. So you could actually set that up on depreciation and depreciate that over a period of time as opposed to all at once. So those are just a couple things to think about when it comes to managing lower farm incomes. I want to quickly talk to you about farm income tax averaging. And the reason why is that it is a really neat strategy that is completely legal and above board that we have in our toolkit here to help smooth tax liability over time. And so this would be in a situation where your income, your farm income has jumped up significantly, 1 year compared to the previous years. And basically what we're doing is we're spreading your current farm income over, like I said, these 3 previous years or base years. And we're doing that in equal proportions from your elected farm income. And so let me just quickly show you a completely made up example. But assume that this is a situation that you're facing or similar to your situation, such that in 2018 you had $5,000 of taxable income, in 2019 you had $10,000, in 2020 you had $15,000, and then all of a sudden in 2021 your income jumped up to $105,000. Now what I do need to say is that the 2018, 19, and 20 years is not just farm income, that is your total taxable income, but in 2021 you're looking just at your net farm income. And so what I'm saying there is that whenever you do farm income averaging, you are only averaging the farm income portion, but you're having to average that out over your total income in the previous 3 years. This doesn't matter in the case if there is no off-farm income, but this can have a significant impact if there is off-farm income, because if that off-farm income is high, it basically reduces the effectiveness of this. So your marginal tax rates at those taxable incomes would be 10, and 12% for 2020, 2019, and 2018 respectively. And then your marginal tax rate for 2021 at $105,000, assuming married filing would be 22%. So if we just do the math real quick, and hopefully I did my math correct, your total federal income tax liability would be just around $14,600, which would work out to be about 13.91% effective tax rate. What we're going to do is I'm going to challenge you to think about your income tax brackets kind of like as cylinders that we're trying to fill up. And so this is our 2021 taxable income year and our tax brackets. And we're trying to fill that up, or we're not trying to fill that up. That is what it looks like filled up with $105,000. If you go back to 2018, 2019, and 2020, we actually have room left in our 12% brackets that we did not use up. At that $5,000, $10,000, and $15,000 income, we were just into, we still have a portion of our 10% bracket that we can use. More specifically, in 2018, we had $14,050 remaining in the 10% bracket, $9,400 remaining in 2019, and $4,750 remaining in our 10% bracket 2020. In 2021, we've got $23,950 above our 12% bracket. So what we want to do is focus here on these unused portions of previous year's tax brackets and take income from 2021 and stick them back into these years. So specifically what we're going to do is we're going to take 105,000 of our 2021 year income, divide it by 3, and put $35,000 into each of those previous 3 tax years. So it says elect to average. So the thing with farm income averaging is that you can elect anywhere from, well, $3 because you're going to divide it by 3, up to what your total farm income is. So you don't have to do all of it, and you can do a portion of it. But for this example's sake, I'm going to just take the full 105 divided by 3. That gives me $35,000. I'm going to plug $35,000 into 2018, 2019, and 2020, and use up some of those otherwise unused tax brackets. So now I'm taxing $14,050 of that $35,000 that I moved into 2018 at the 10%, $20,950 at the 12%, and the math continues on. What I really want to show you, one, I do the illustrations to just kind of get your head wrapped around how it works. But what I really want to show you is that there's a tax savings here. And it's not huge with this example, but it's $2,500. So if we go back and if we go back and use those unused brackets, the portions of those brackets, I've lowered my effective tax rate from 13.9 to 11.46, so about 2.5%, or a savings of about $2,500. Like I said, this is completely above board, completely legal. It is underutilized. The IRS even acknowledges that it's an underutilized tax tool. And something that I encourage people to think about, because it's low-hanging fruit out there. All it is some clicks of the mouse and some entering of some data in the tax return, and you're saving money on your taxes. I will warn you that the effective rate only includes the federal amount. We're not talking about self-employment FICA taxes, state or local taxes, and with that being said, farm income averaging does not save you any self-employment taxes, just saving you on the federal tax side. However, especially for young and beginning farmers, or for farms that have went through transitions and they've had large losses in previous years, and then income jumps up significantly, that savings can be huge. That year that your farm income jumps up, you average it over 3 negative years, you're talking about significant savings. So I encourage you to think through that. Lastly, but not least, I do want to just mention this, easing the concerns of multiple year farm losses, or what you'll hear people say, farm losses versus hobby losses. This is something that I get asked about a lot in situations where people have not shown a positive Schedule F income in a while. And just as a reminder, Congress says that in order for us to deduct our expenses in excess of our income, we must be engaged in this activity for a profit. And profit in this context refers to income being greater than expenses, where depreciation on capital assets is included as an expense. And there's a safe harbor in the sense that if you can show a profit in any 3 out of 5 consecutive years for agriculture or other businesses, or 2 out of 7 for equine, then you automatically don't have to worry about this. But let's say that you don't meet that safe harbor definition. Let's say that you only show 1 year of profit in the past 5, or 0 years of profit in the past consecutive 5 years. It does not mean that you are automatically considered a hobby venture by the IRS, but it does allow the IRS to dig deeper into your operation if they so choose. So this comes up whenever you get audited. If you do get audited, or if they start auditing, looking for hobby operations. Once again, doesn't automatically mean, sometimes people think, I don't have 3 out of 5, oh my goodness, I'm in trouble. No. What it does mean is that if the IRS wants to come snooping around, they've got the justification to do it because you don't meet that 305 rule. So how do we protect ourselves against this? There are 9 areas of consideration that the Internal Revenue Service looks at to determine if you are actually a hobby operation or an actual business venture. The first is, are you carrying out the activity in a business-like manner? These are going to be things like, having a business plan, having a separate checking account, those kind of things to try to make yourself look as much like a business as you can. They look to the expertise of you and your advisors. So, keeping up with your continued education, that you do through trade shows and through extension and stuff like that is really important because that helps show that you are, engaged and are trying to learn how to make more money. They will look at the quantity of time that you are investing in the activity. I'm not saying that you need to install a time clock and clock in and out each day, but you do need to be able to justify to the Internal Revenue Service that you are putting in an adequate amount of time in the business and trying to make it profitable. Is there an expectation of asset appreciation? I'm not sure how you explain this to the IRS, but this is one of the areas of consideration you can look at. I guess don't ever let them think that you thought the business was going to fail. I don't know. This one's a bit tricky. Area 5, they do look to see if you've done this before, and more specifically, have you done this before and failed? Not that that is an automatic, situation where you're in trouble, but if you have a tendency to open up a lot of businesses and bankrupt them time and time again, that can be a problem. What is the history? So they will look at, economic cycles. Is it possible that you're just in a downturn and, maybe you're in the trough of that downturn and it has lasted for a while. And so they'll look back over, previous profits and losses. They'll go back to the beginning of time and see if you've ever made any money whatsoever. Once again, maybe it's just an economic downturn that's part of the ag cycle, whatever the case may be. So if they go back 10 years, maybe you were profitable, for example. They do look to see if you were engaged in other income generating activities. This really has become a problem for people who have large off-the-farm incomes, so big W-2 incomes, but also have to lose a lot of money on the farm. So be wary of that. If you are fortunate enough to fall into that category where you have a lot of money coming in off the farm and you happen to lose a lot of money on the farm, you should probably give me a call sometime and we should talk about ways to try to shore up your business plan. And then last but not least, they look at fun, and more specifically, are you having fun? Nothing irritates the IRS more than people doing pleasurable or recreating. I say that in jest. They do look to make sure that you're not taking lavish trips and for recreation and pleasure purposes and writing them off as business expenses. As I always tell everybody who's concerned about this, take these 9 areas of consideration into consideration, get yourself a good business plan, try to hit all the points here, and then don't worry about it because most likely you're going to be just fine. But just, be judicious and think about what you're doing, how you're doing, and try to protect yourself as best as possible. With that being said, there is my contact information. If I can be of any assistance to you, about anything that I've talked about tonight, if you've got tax questions, if you've got business plan issues, if you've got liquidity concerns, feel free to reach out to me. I'll be more than happy to share my knowledge with you and help you get pointed in the right direction.
Thanks, Jonathan. And just a friendly reminder to everyone, if you have any questions for Jonathan, just drop them into the Q&A box at the bottom. Jonathan, you did such a good job with that topic that there are no questions right now. So I think we're going to move on, but Jonathan's going to stick with us through the evening. And so if you think of something through the next presentation, feel free to drop those in there, and we'll get to them at the end of the next two presentations. Kenny, with that, I'm going to turn it over to you and let you cover our next topic.
Excuse me. Well, thanks, Becky. I'll just fire right up here and go. So obviously got questions, sort of send them to me as well. So I want to talk a little bit this evening, the next probably 25 minutes or so, about livestock risk protection insurance. And I've done programs on this really now for, I guess, about 10 years, but I've done a whole lot more over the last year because they have increased the subsidy level on LRP such that it is much more attractive now than it used to be. And as Greg was going through some of those budgeting scenarios last night, if you remember at one point when he was going through some of the feed-based backgrounding programs, he even said, let's look at a scenario when that price we expected ends up being $10 per hundredweight lower. And what that really was doing was kind of setting the stage really nice for me to talk about, price risk and how we might manage that. So I want to spend some time talking about that. I'm going to go through the basics very quickly. As soon as I can, I want to try and get into an actual illustration because I'm one of these folks, I believe the best way to learn about something is actually to kind of get your hands on it and kind of use it in a practical setting. So I'm going to try and kind of simulate that here for a stocker operation in about maybe 10 minutes or so. So livestock risk protection insurance is an insurance product that is subsidized and it's designed to protect you against decreasing cattle prices. If you've ever had an insurance policy that may be paid out based on county yield, not your yield, or if you've used PRF insurance or something where the payment's based on rainfall in a certain grid, not your farm, you know how an index insurance product works. An index insurance product works. And LRP is like an index insurance product. The indemnities, the payments you would receive are not based on what you sell your cattle for. Instead, they're based on changes in the CME feeder cattle index, which we talked about some yesterday, or actually we talked about, I guess, maybe more on Tuesday night. We talked about futures and options. So the idea is you're buying an insurance product that's going to pay you based on changes in that index. And if that index changes, meaning if those feeder cattle prices out west change, most likely the same thing is true for the cattle that you're going to sell in the future. It works very similar to a put option. So if any of you have heard any of the programs I've done in the past on using futures and particularly options, it's very much like a subsidized and scalable put option. Now, that CME feeder cattle index we talked about on Tuesday night, we talked about how that's actual cattle sales around 800 pounds in 12 key states. I just wanted to kind of show you this evening. Here's the actual 12 states we're talking about. So we're talking central US from the southern plains up to the northern plains. Those are the states we actually use to actually estimate or actually calculate that CME feeder cattle index. As we talked on Tuesday night, there's a difference in what Kentucky feeder cattle sell for and what similar weight feeder cattle sell for in those areas because they're closer to the major cattle feeding areas. I'm not going to spend a lot of time on this. I'm going to try and focus it as simple as I can to get the points across tonight about how LRP works. But I do want you to understand that while I'm going to apply it to a heavy feeder steer scenario, there are provisions made where there's adjustments for calves, for heifers, for cattle of Brahma influence, dairy influence, things like that. There are maximums in the number of cattle that can be covered. There are very few folks I work with in the Commonwealth where that's an issue. But I want to draw your attention to the very bottom because the most attractive thing about LRP insurance is that I can buy it in most any quantity that I want. One of the challenges of using futures and options to manage price risk is the 50,000 pound contract size that matches those truckloads we talked about last night. In this case, I can buy it on a very small number of heads. So no matter how big or how small you are, you probably can use LRP as a way to manage price risk and protect yourself from decreasing cattle prices. Now, I'm going to jump into an illustration here very quickly. Now, this is just to give you an idea of how you actually go about selecting coverage levels. So a couple things to understand. So first of all, every LRP policy has an ending date. Literally yesterday, I pulled this morning, I could have bought an LRP ending date of August 17th, okay? So August 17th, 2022. And at the time, the expected ending value on that policy was $179 per hundredweight. What that means is, based on largely August futures, that's the expected value of the CME index on August 17th. So every policy has an ending date. Every policy has an expected ending value. Now, that's there. Then I have to choose what coverage level that I want, meaning how much insurance coverage do I want to buy. Again, yesterday, I could have bought a coverage level, and I rounded these a little bit, but right around 178. That would have cost me $5.22 per hundredweight. That would have been pretty expensive. So $5.22 on every 100 pounds that I cover. And that's like a very low deductible insurance policy. The index is expected to be 179. I buy coverage at 178. If on August 17th, the index is below 178, then I'm going to receive compensation. So I've only got to self-insure a very small amount here. Also yesterday, I could have instead chosen a 172 coverage level. We can think about that as being about $7 out of the money, or a $7 deductible. And that would have cost me a fair amount less. That would have cost me $3.45 per hundredweight. And then if I wanted to get something a little more catastrophic, another one that I could have bought yesterday, I could have bought the exact same ending date, exact same policy with a coverage level of 166. And again, in this case, I've got to self-insure that $13 drop. That's like a $13 deductible, if you will. And that would have cost me yesterday just a little over $2 per hundredweight. Now, to make sure we're on the same page, these premium levels are paid, like I said, on every 100 pounds that I cover. So let's just say that very simply, I'm going to cover one head. I'm going to sell one steer that weighs 700 pounds in August, and I buy this policy on him. The cost per head on him is going to be $3.45 if I choose that coverage level. I'm going to pay that on 700 pounds. It's going to cost me $24.15 per head. So if I were covering 100 head of cattle in this exact scenario, I'm going to have a cost of $2,415. So that's how it works. Now, immediately, I want to jump into an actual illustration and think about a summer stocker scenario. So, Greg does most of our budgeting, does a fantastic job. He did a great job both Tuesday and Wednesday talking through some of those things. So I'm going to show you a quick budget, but I'm going to focus more on what happens when price changes. So we're just going to assume I'm going to place some 5-weight steer calves here probably very soon. I'm going to do some very simple roughing economist math here. I'm going to assume they gain 1.5 pounds a day. And I'm going to kind of arbitrarily choose a 167-day stockering period, which honestly may be a little bit low. But I do that on purpose because I want them to be exactly 800 pounds when I sell them out in October. That's kind of how I got there. I'm going to assume it's 3/4 acre of pasture per steer. And I tried to make this as current as I possibly could. So today, at least this afternoon, last time I checked, the October futures price was just under 184 a hundredweight. So what that means is if I were buying an October ending date, I'd probably expect that expected ending value to be around 184. And then based on the things that we talked about already, mostly on Tuesday night, we got to think about basis. I'm just going to kind of make a simple assumption here going forward. I'm going to say based on the kind of cattle that I sell and how many I sell at one time, I think that if the CME index is at 184, that probably means my cattle sell for something like $12 less than that per hundredweight. So I'm going to think about a sale price of roughly 172. Now, I don't want to get too wrapped up in the details of the budget here. I just want you to know that I do have some expenses included. So here's that expected sale price, which is, again, it's the October board at 184 minus a $12 basis. So I'm assuming I sell my steers in October at 800 pounds for $1.72. I had to just kind of take a stab at what's a realistic expectation for what I might pay for calves in a week or two. Greg and I were talking last night, a lot of things point to the likelihood this calf market runs some the next several weeks as grass comes on. So this is probably a little bit of a strong price right now. State average is 170. The groups I've been seeing are, 175 to low 180s. But I think, they're going to, I think, run here shortly. I do have some pasture cost in here. I've got pasture rent. I've got mineral. I ran some vet and medicine. I did include commission, some money to haul. I do have some other expenses in there, like Greg mentioned water last night. I also dropped in a 4% interest rate on operating loan. Jonathan and I talked about that this morning. And then I plugged in 2% death loss. So I've got some basic cost in there, but again, I don't want you to worry too much about the actual numbers. Just kind of assume I've made my best guess here. What I want you to focus on is, okay, if the futures market holds, and that's actually what those cattle sell for come October, and if my expenses are roughly accurate, including what I pay for this steer calf here pretty soon, then I'm looking at what I think would be a pretty good return to a summer stocker program. And I'm estimating around $135, $136 per hundredweight. Okay, so this simple budget based on some simple assumptions. Now, how would I utilize LRP in a stocker setting like that? Again, I'm going to be selling heavy feeders, 800-pound steers sometime in October. We'll kind of assume I've just bought those calves and ready to move those now, or I've just placed those calves recently. And again, my concern is I know for a fact that if that sale price is not what I expect, it has a big impact on what that bottom line is. So I want to do something to protect that sale price. So I go in and I purchase an LRP policy with ending date in October. The expected ending value, because the October board's at 184, is going to be right at 184. And let's just say, for the sake of argument, that this time I choose a coverage level of about 176. That means I've got to self-insure the first $8 decrease in that price expectation. That's like my deductible. And again, based on what it would have cost yesterday for an October ending date, that would have cost me about, and I'm rounding here, about $4 per hundredweight. So I'm going to be selling 800-pound steers at $4 a hundredweight. That's $32 a head. If you want to kind of think about what this does from a practical perspective, okay, I've got coverage at 176. That means once the CME index gets below 176, I start to get dollar per dollar compensation. If it goes there and just flat out stops, let's say it ends at 176, then most likely I sell my cattle for $12 a hundredweight. Less than that, they sell for 164. So that's kind of my price floor. And then I'm still out $4 in premium cost. So the best way I think to think about that is, notice the yellow highlight there. I go back to that exact same budget, and then I just treat this insurance, this LRP insurance, as an expense. Okay. So I've taken what I thought would be a $135, $136 return. I've added a $32 expense for LRP insurance. Now my expected return is $103, $104. I'm just treating LRP as an expense. I've bought some insurance, and we'll see what happens from there. Now, I'm going to talk you through two scenarios, two simple scenarios. One where prices go up quite a bit and one where prices go down, because I want you to understand what happens when I've got insurance coverage and the market changes. And I promise you, the markets almost always change one way or another. So let's say prices run a lot. Okay, so the expected ending value today, when we were talking about this, was about 184. Okay, let's say though, on that ending date, about the time I sell those cattle, that CME index is actually 204. In other words, the market has increased by $20 a hundredweight above what the expectation was. So in other words, October feeder cattle futures have increased $20 between now and October. If that's the case, I probably sell my cattle for $12 a hundredweight back of that. Those 800-pound steers sell for $1,536. I've spent $4 on insurance per hundredweight. That's $32 a head that I've already paid or gonna have to pay. All right. But folks, this is the best case scenario. The best case scenario is I bought LRP insurance, the market improved, and I look back and say, you know what, I didn't need that insurance after all. That's the best case scenario. And that looks like this. Here's my LRP expense, okay? But here's what I sell my cattle for in October. Instead of selling them for 172 and making, it was a little over $100 a head, I sell them for 192 on a much stronger market, and my return is $263, $264 per head. This is pretty much a home run scenario. Best case scenario. Bought LRP, didn't need it, but I got to enjoy a really strong market, and I got to reap some pretty nice returns. And then here's the other extreme. Let's say those prices that are going up by $20 a hundred between now and October, they come down. So that ending value ends up being 164 instead of 184. So it's $20 per hundredweight less than expected. What that means is that would mean that October feeder cattle futures price fell by 20 bucks a hundred between now and October. I'm going to sell my cattle on a much weaker market. If my negative $12 basis estimate was right and the index is 164, that means I probably sell my cattle for 152. They sell for $12.16 a head. But I did buy that insurance at $32 a head. And here's where it kicks in. All right. I had bought coverage, if you remember, at 176. The actual index is at 164. That's a $12 difference per hundredweight. So I'm going to get an indemnity of 12 bucks a hundred on every animal that I had insured. And I assumed 800-pound steers. So that's 96 bucks a head. This is the worst case scenario for me. But the good news is the insurance kept this from being worse. Let me show you what I mean. Okay. So my sale price that I thought was going to be 172 ends up being 152. The good news is, though, the insurance kicks in, and in addition to what I sell the cattle for, I get an indemnity from the insurance company of 96 bucks a head. I still spent the $32 on insurance. I walk away here with a $40 profit. Now, this is roughly $100 less than I thought that I would make. But understand what happened here is the market dropped by 20 bucks a hundredweight. Okay, that's $160 worth of value on an 800-pound steer. And I was able to still walk away with a small profit. Okay, that would be a win if the market dropped that much. And let's be honest, the market could drop that much or even more. We've seen it happen sometimes in the past. Now, I showed this to a lender group probably about 3 weeks ago, and a lender friend of mine said, you know what, you really ought to show what would have happened in the exact same price scenario if you hadn't had the LRP. I said, great idea, I should definitely do that. So here's the exact same thing. So here's the same market. I sell those cattle for 152, and I sell them for 20 cents a pound less than I thought I was going to. I had no insurance, so I didn't have the expense, but I also don't have the indemnity. And again, the loss here in this example was about 24 bucks a head. So I turned what looked like, over $100 a head profit, even with insurance priced in, to a loss of 25 bucks a head that I've got to somehow recover from the following year. So LRP made a big difference. And obviously, if something like this happens again, if this ended up being a 25 or 30 cent price drop, then this number there at the bottom gets even uglier. So provided some downside protection for us and still gave us some upside potential. One way to kind of look at this is, okay, given what the market did, what the actual LRP ending value was, how did that impact my return per head? So I'm going to kind of show you the first one. So if the CME index, the LRP ending value did the same thing, ended up being 180, all right, this is still above the coverage level that we bought, okay? So we get the benefit from a little bit better price. We don't get an indemnity. Walk away with 72 bucks. This is kind of a scenario that I didn't talk about much, but it's one of these things where the market can drop a little bit, but not enough to trigger my coverage level. And that's kind of what happened here. But I want you to notice, though, as that index falls below our coverage level of 176, our floor kicks in, that roughly 40 bucks a head. And we kind of set the worst case scenario there, assuming our basis estimate was pretty close. And the beauty of this whole product is, as the market runs up, I can benefit from a rising price. So I've got a price floor in place, but I also don't set a cap on what I can make. Whereas if I were entering in a forward contract or something, I've set really both a price floor and a price ceiling at the same time. If you're more of a visual type person, I like to show it this way sometimes. If I have no price protection, and if the x-axis here is the overall market and the y-axis here is my return per head, I'm going to live and die by that market. So if the overall market's good, my return per head is good. Overall market stinks, my return per head stinks. We didn't talk about forward contracts, but this is basically what I was expecting going in, right? But if I had something set up in place where I had a forward contract, maybe that return is about 115 a hundredweight. This is what LRP does, though, okay? So it sets me a floor at some point. So no matter how bad the market gets, I've kind of got a floor in place, in our example, around 40 bucks a head. And then as the market improves, I can still benefit. And the difference between the LRP outcome and the no protection income is what I spent really in premium. And in our case, that was the $42 per head that we spent on LRP insurance. So kind of another way to think about what that looks like when I'm looking at what the outcomes would be from using a product like LRP. I'm going to mention 2 or 3 more nuts and bolts things, and then we'll shift gears and Greg will wrap us up. This is a legitimate question folks ask, but what if I need to sell my cattle at a different time than the ending date? And obviously you want to grab an ending date that's as close as possible when you plan to sell the cattle, but you're not going to find a perfect match. These are offered every 4 weeks. So if there's something offered in the middle of October, their next option is going to be middle of November. You want to match them as close as you can, but just remember that the ending date is really all that matters. The indemnity is only calculated on that day. I tell people that know futures, I say it's kind of like buying a put option that can only be exercised at expiration. There's no other value other than that actual day. I can sell the cattle as many as 60 days ahead of time, but just understand that if I do that and the market changes after I sell those cattle, that could affect my indemnity. In other words, I may sell the cattle 60 days ahead of time, thinking the market's down and I'm going to get an indemnity. The market ends up rallying some between then and the ending date, and I don't get an indemnity at all. I can sell the cattle anytime after the ending date, but again, if I do that, then I'm unprotected past the ending date. So everything is triggered based on the ending date on the policy. People ask me this question sometimes, they'll say, well, how do I decide what coverage levels to buy? Because in a lot of cases, you're going to have a lot of options as to what you can buy. There's no super easy answer here. There's no one size fits all, but it depends on your risk preference and your financial situation. What you're really doing is you're balancing the coverage level, meaning how high coverage you want with what you're going to spend in premium. And what I tell folks is, sit down, push the pencil, look at how sensitive returns are to price change. I like to work through things, can I buy LRP coverage that makes sure I can at least cover my cost of production so I can pay my bank loan? Can you self-insure some loss? Some people can and some can't. And have those conversations with your lenders. A lot of folks first become interested in LRP because their lender wants them to look at a way to manage downside price risk. And the more vulnerable you are, the more highly leveraged you are, typically the younger you are or the newer you are to agriculture, the less risk you can afford to take and the more aggressive you need to be with your risk management strategy. Those of you that have some experience with options, for years when I talked about LRP, I told people that if they were big enough to use put options, I would probably stay with put options because they're more flexible. But LRP, now that it's cheaper, I'm really telling even a lot of my larger folks, I think I'd be looking at LRP right now. You're paying about 35% less than what you'd pay for a comparable put option. So it's much more attractive. So you've got a premium subsidy that's pretty significant on LRP insurance. I can buy it in any quantity, 5, 10, 15 head if I want to. I'm not locked into futures contract quantities of 50,000 pounds. There's also no commission, no concern about margin call, anything like that. And if you don't use futures or don't know what I'm talking about, don't worry about this. But when they first came out with LRP, they did not allow you to use LRP insurance and some sort of comparable future strategy. They've stopped doing that now. So if any of you like to combine put options with call options and do some creative things like fences, you really ought to look at LRP because you might be able to find a cheaper solution to get your downside. And then look at, if you want to write a call option, look at combining that with LRP instead of combining it with the put option. If you don't know what I'm talking about, that's perfectly fine. That's just an advanced strategy that some people like to use. And I think we need to think about using LRP instead of put options because of the price. The only downside to LRP, besides the fact that some very large producers could simply, be too big to cover all their cattle, is that it's less flexible. And this is the one downside. And this comes down to that ending date. So if for some reason I needed to sell cattle earlier because of drought, or maybe I had good pasture and I want to keep cattle longer, I can always just simply get out of an option position or grab another option. I don't have that ability with LRP. Again, I'm locked into the ending date, and if I change my sell date, I've got some flexibility, but I don't have really good protection if I change that on when I actually sell those cattle. So flexibility is the only downside of LRP compared to put options. Most everything else, LRP works a little bit better. If you've heard me do risk management programs before, I like to end with just kind of some general thoughts. I'm just kind of stop with 3 here. But the most important thing I think to do, and Greg did a great job talking through this last night, is do some sensitivity around sale price. If you're a margin operator, once you get those calves bought, nothing is going to impact your return any more than what your sale price ends up being. And it'll surprise you sometimes how much difference that can make. Think about our example of 800-pound steers, all right, that we're going to sell in the fall. Let's say expected profit's $120 a head, which is a pretty darn good return, okay, to a margin operation. That means a 15-cent change in that sale price takes that profit down to 0. And folks, we've seen those kind of swings within a year multiple times over the last 10 years or so. So just know how sensitive your returns are to sale price. And this is one way to protect that price. Set your pricing targets ahead of time. There's always folks that want to wait and not cover their downside immediately. They want to look for the right time. And I'm not going to argue with that. That's fine if that's what you want to do. What happens though, as the market starts to move, our mind starts to play tricks on us. Okay. Let's say we place cattle, the market runs really good in our favor, and all of a sudden we're going to be making a whole lot more money. Logic tells us we probably should do something to protect that, but the market's running and we're afraid that we're going to jump too early on it. All right. And sometimes we kind of have what I like to call analysis paralysis. We don't do anything. So what I tell folks to do is, if you don't want to do anything price protection oriented when you place those cattle, write down when you're going to move. If I can get LRP insurance at this coverage level for this price, I'm going to do it. And then when it gets there, make it happen. Don't be thinking about it in real time. The emotions will make it very difficult for you to make an actual decision. And again, kind of the counter of that, I like to say is, if you're not jumping on a market too early, and if you're not leaving money on the table occasionally, you're probably taking too much risk. And that really is what it's about. It's about looking for kind of long-term, looking for stability. We're not trying to hit home runs all the time, because home run hitters strike out a lot too. We want to consistently have decent returns. We want to cover our downside so we can play again and have a good year the following year, regardless of what the market does. This is the last time that I'm going to speak with you other than questions. I think I showed you my contact info last night. Obviously, reach out to me anytime. I enjoy talking with you, whether it be LRP or any other topic. I would be happy to hear from you.
Thank you all for the great questions during Kenny's presentation. I think what we're going to do, though, is let Greg kind of wrap up everything, and then we'll address the questions that we've gotten in the Q&A box at the end. It's not too late, so if you continue to think of more questions, just continue to drop those in there, and we will get to them when we're done. Greg, you want to finish this up?
I will try. Thank you much. So good evening, everyone. I've been tasked to do the last formal presentation. We are going to have hopefully lots of time for questions at the end. And to help that, I'm going to keep this short and sweet. So this should take probably 5, 6, 7 minutes or so, not very long. Basically just going to hit on some of the highlights for the last couple of nights, and then we will get into questions. So the first kind of big picture point I just wanted to hit over again is we are essentially in a very different era this year compared to where we've been. Now that may change 1 or 2 years from now. We might be in the complete reverse. We might go from high feed costs to low feed costs. So this, you can think of it both ways here, but just think about we're in a different type of era and the implications that has. So we've got completely different dynamics, particularly say on price slides. Those price slides have gotten really small compared to where they were when corn was say at $3.50 or $4 a bushel. And that's creating new opportunities as well as new challenges. So it's kind of the type of thing where if you don't change, you can get into trouble quick, or you can miss some of those opportunities. So hopefully that seems obvious, but just realize whenever we have changes in markets, whether it's feed or the cattle, which in this case right now it's both, we've had big changes in both, you need to kind of reevaluate and look for those new opportunities. Kind of to make a point with this, again, we looked at this last night when we went over some of the budget scenarios. This was for the backgrounding. What I want to point out again here, if we bought those, with all the assumptions, and I'm not going through all those, but this essentially that's the same set of assumptions we looked at last night. If we had to buy that 550-pound steer at $1.95 in that backgrounding operation, we basically just made $25 an animal that had to cover some other costs that we didn't include there, right? Like our fixed costs. Hopefully, especially if you bought in the last few weeks, you were able to buy quite a bit lower than that. But I guess what I want to get to is that may change here very quickly. So this is from the market report that came out about a week ago, and that would have been essentially covering the previous week. So this is almost 2 weeks old, but you look at those, steers centered around 550 pounds, and yeah, we were able to hopefully buy quite a bit under that $1.95, hopefully getting that 75, maybe even better profit per animal. But again, that was a couple weeks ago. You may still be able to get prices around there, but my guess is it's probably changing very quickly, and probably this week and next week are going to be, we're going to see some pretty quick price increase on that. This is also something we saw yesterday. This would be for the stockering operation. So basically folks are going to put that same size steer on grass in April. And you saw roughly what they could bid at what price to get the same types of gross profits. And I guess what I want you to key on there is even at $2 a pound, that was on the low side that we looked at, they're making $150 profit. So again, once these folks start bidding on calves, you may have a hard time getting that 550-pound calf for $1.95, and hopefully you can see why here. So why have we had these prices? Part of that, in other words, why haven't these prices risen as quickly as maybe Kenny and I would think? Part of it is just that, again, this is probably 2 weeks ago. Very few stocker operators were really looking at placing calves unless they had some hay that they planned on feeding. But again, things are dynamic and changing. So part of it's probably that it was just a little bit before kind of what we call grass fever. But part of it may be something else, and that's what I want to go to here. So this is same slide, one of the slides we looked at last night. And what I want you to look at here essentially is, and both Kenny and I mentioned this, is the carry, what we call the carry in the market. So that March contract, which is basically getting ready to expire, $1.51 or 151 hundredweight. And look at how quickly that rises through late summer and early fall, well over $20 a hundredweight. And so that's what we call a carry in the market. That's what we're going to sell on in August, September, October, particularly for a stocker operator. And what our guess is some folks are bidding on calves aren't really looking at that. They're looking at what the current prices are for, say, 800-pound steer, whatever they're thinking of selling at. They're looking at that in terms of, what can they afford to pay for an animal now when they're going to sell it roughly, say again, at that price 4 or 5 months from now. But don't make that, don't fall into that trap. In this case, if you're in that assumption, you're probably not going to be able to buy calves, because people bidding against you are going to be able to bid a whole lot more, because they're looking at what they're actually going to be able to sell them for, which is $20 or more dollars a hundredweight more than what you might do. So part of it is we haven't quite got to grass fever, but part of it is just we typically see this, and when there's a big change in market like this, sometimes people don't look at that months in advance, or they're still kind of set up, where are those steers that I'm going to sell at now versus where are they going to, or where are they predicted to be 4 or 5 months from now. Let's see. The last thing I guess I wanted to show here is, okay, let's go back here. Let's say that we're the backgrounding operation, and we literally just, at this point, let's say we haven't got calves up to now. We start bidding on them next week or the week after we hit grass fever, and we literally can't even get them for $1.95. Definitely not $1.90. So what options do we have? Well, one of them is coming back to the slide that we looked at yesterday, and that is we actually have a pretty good carry. In other words, instead of selling the calves are 800 or 850 pounds right now, One option you have is holding on to them. We talked about that last night. I'm just going over it again. Again, if you look at that, the carry just between the March and April, we've got a $6 carry. Now, part of that is because of the way that the March contract closes, but probably realistically, we have at least a $3 carry, maybe a $4 carry between now and say mid-April. So I won't go through the whole details on that, but again, from yesterday, we could potentially keep that animal another 30 days or longer and make a little bit more money on that last group of steers or heifers, whatever we're doing, until after grass fever kind of passes, say in the late May, early June, and then pick up calves at that time. One last thing here, this would be for stocker operators, but in the assumption that we used, or the scenario we used yesterday, we're assuming that we're going to sell October 1st. And that's always good for planning purposes. In other words, you want to kind of have a plan in terms of when you think you're going to sell, but then when we actually get there, you can kind of reevaluate things. One thing I want to point out here is that right now, once we get past September, the market is actually coming down. And quite often this is typical, it doesn't always happen. But in other words, we're planning on selling October 1st. There's a cost to actually taking that last month because it's going down $2 a hundredweight. In other words, if we had sold in September, yeah, we're going to have a slightly, the calf isn't going to be quite as heavy, but we're going to lose part of what we gain in weight just on that decrease in the overall market. Now, again, we can wait until say August, early September before we start looking at that again, and the market dynamics may change by that point. In other words, the October may be comparable to the September in terms of that expected price for that 800 or 850 pound steer. So the point being, just reevaluate things when you get closer to your plan sale date and make adjustments potentially at that point. Final thoughts, know your profit margins. So that's kind of going through the budgeting process that we looked at in terms of estimating what those margins are likely to be. Know your risk tolerances. This was kind of the key of one of the things that Kenny was concentrating on. I don't do a whole lot of marketing and risk management, but I like to simplify just because I don't go into detail. So I usually just say, you need to know two things. One is how deep are your pockets? So first of all, not everyone has to say use price risk management for their cattle. Some people never hedge their cattle, and in the long run, they may do just as well as people that do hedge their cattle. But to me, you need to know two things. One is how deep are your pockets? In other words, the deeper your pockets, the more that you can take a hit in 1 year, because over time, those hits are going to be counterbalanced with the years that you do hit that home run, kind of in Kenny's analogy. If you have those deep pockets, you can ride out those deep losses, especially again, if you're early on, if you're just getting started, you may not be able to take one or two big hits in a row. That may put you out of business. In other words, your pockets aren't deep at that point, or in that situation, you probably need to think more about risk management and using something like LRP to insure those cattle. The other part is pretty much psychological. That's how, do you have a stomach that's, a stomach that's made of steel? Let's just put it that way. In other words, if you get queasy when you take a big loss, so let's say you've got those cattle, the market goes down $20 a hundredweight, you were thinking you're gonna make $100 profit. Now you're looking at losing $100. Overnight, that psychologically for some folks can be a hard thing to take. So if you can't take that hit mentally, even though long run you're going to make that up in terms of the years that you hit that home run, in that situation or that type of tolerance, it's probably more important to take some kind of risk management strategy. So those are the two things I usually look at or tell people to try to think about. And finally, know your markets. And again, this has changed drastically here from where we were a year ago, both on the feed side and on the cattle side. So stay in touch with how those markets are changing, know how they're going to change dynamics like price slides, et cetera. And you can't just kind of sit back and do what you did every year. If markets aren't changing, you can, but when you have changing markets, you will get burned at some point if you don't kind of evaluate those changes. And that is it for that summary. And we can have questions basically of anything tonight, or really anything from the last 3 days, I think. So Probably, I'm guessing Becky would like to take those questions from tonight first, because I know we have some coming in. So probably she's going to ask those first. And then if you have any additional questions, that would probably be a good time afterwards. Becky, I'll let you take it over.
Okay. Thanks, Greg. We did get several questions throughout the presentation, so we'll work through those now. Thank you all for the great questions too. So the first one is for Jonathan. Is there a method to spread out natural gas lease income?
No, at least nothing that comes to mind. I'm not saying there's nothing that exists out there, but it's got there'd have to be some pretty creative ways to do that I'm not aware of. So yeah, I don't think so.
Jonathan, the next question is for you in reference to the 1099 conversation. And they're asking if you'll put the 1099 slide back up on the screen, if you don't mind, and then I'll ask the question once you have that up.
Sure, just 1 second. I have to find it. I believe this is the slide. Oh, I keep losing it. Sorry. Let me go back to the presentation. Can you see it now?
No, I think you need to share your screen.
Oh, thought I had. That'll not do any good at all. But all right, we're getting there. Now you should be able to see it.
There we go.
All right, finally.
So the question is, does a 1099 need to be issued to the sellers of cattle purchased?
No, so in general, if you're receiving anything for that beyond services, so if you're receiving a tangible product, feed, cattle, so on and so forth, you don't have to give that 1099 to that. Now, fencing, for example, you do. I mean, you are receiving the fence, I guess. You can go out and touch that fence, but the labor associated with that, you do need to send a 1099.
The next one is a follow-up question to 1099s. With regards to 1099s and veterinarians, if the vet operates as an LLC, do you still have to send them a 1099?
Yeah, the interesting things about veterinarians, and this is what kind of throws everybody off a little bit, is that they're supposed to get a 1099 regardless of their business entity status. And like I said, that was part of the Affordable Care Act, something that was slid in there at the end. I don't understand completely the motivation behind it, but yeah, a vet gets one regardless of business entity status. And there's pretty low compliance with that currently.
Okay, that was the last of the 1099 questions, so I think we're good there. The next one is tax related, and it reads, you mentioned the need to deduct price of non-breeding stock in the year that it is sold. How do you determine the price of sale for that animal in the circumstance where the meat is sold in packages which are commingled with those of many cows?
Yeah, so that's a good question. And just one clarifying point, you're not able to deduct the price of non-breeding livestock unless it's in the year of the sale, and that's dealing with purchased market livestock only, of course. So that's one clarifying point. So we're talking about buying animals, bringing them to the farm, fattening them up, maybe finishing them out, and then slaughtering them. And in this case, we've got freezer beef, for example. So the question is, how do you keep track of all that? That's a very good question, and it's something that is a bit of a struggle. But keeping good records, animals, with these tag numbers were bought at this time and are being slaughtered at this point. So how do you do that if, let's say that you've slaughtered a steer, you finished when you've slaughtered it, you sell half of it, 1 year and half of it the following year. Yeah, I mean, you do your best to get it as close as possible. You make a reasonable effort to keep track of that and split that cost, and you'd be okay.
The next one is, I'm in my operation, can a person buy an insurance policy on cattle if I send cattle out west and retain ownership? So Kenny, I think that's probably geared towards you.
The answer is yes. Now, for clarification, the LRP insurance product for feeder cattle that I talked about this evening was for feeder cattle and tops out at 900 pounds. If you're retaining ownership on cattle in another state, which is very common, or even if you're finishing here for that matter and selling them somehow, you can buy an LRP policy that is geared towards fed cattle, and it works very similarly. I don't work with it as close as I do LRP for feeder cattle, but there is an LRP for fed cattle. The other thing I guess I would say, Becky, just as an add-on, is you've also got other options out there. For example, there is a livestock gross margin product that's out there for fed cattle that uses a combination of live cattle futures and corn price, where you could actually, in theory, get some feed price protection too for cattle that you're feeding. And you could also explore things like forward contracts on cattle that are being fed elsewhere too. So the answer is yes, there is an LRP product for fed cattle, and there's also other options you can use on those cattle as well.
Kenny, as a follow-up to that, is there LRP insurance, and I'm going to do the best with the reading of this question, the indemnity program for fat, finished cattle processed and sold as freezer beef or packaged beef that would provide some protection against a steep drop in the retail beef price?
Yeah, there's nothing designed for people that are selling freezer beef or selling meat directly. The truth is, you could, if you're finishing the cattle, I don't see any reason why you wouldn't qualify to buy LRP for fed cattle on those cattle. But from a risk perspective, the assumption you'd be making is that the live cattle price moves with the value of the meat, and I think that's a stretch. So I think the answer is it would not work very well.
The next question relates to price slide. It says the local price slide is not linear. How do you deal with that when pricing cattle for purchase or sale?
Okay, so I think this probably refers to the discussion I had maybe last night talking about how to sell cattle on a price slide. And when the person asked the question, I didn't see the name, I'm sorry, Becky, but when he or she asked that question, I assume what they're saying is that price slides are different at different weights, and that's definitely the case. So Greg even said last night, the price slide tends to be wider, meaning there's more differential by weight for lighter cattle. It tends to narrow as they get heavier. And it's not going to be perfect, right? Even as he and I were talking, gosh, may have been Tuesday, Greg, about kind of getting a feel for price slide. You're looking at markets, kind of making your best guess. That's all you can do. You just want to set your artificial pricing price slide as close as you can to what makes sense. And remember, if you're pricing cattle, ideally, you're not going to be that far off your base weight, right? So the fact that it's not linear, it matters, but it's, you don't want to be 200 pounds off, right? Hopefully you're within 50 pounds, and then that difference is not as big a deal as when it's wide. So it definitely changes based on the cattle you're trying to sell. Try to match your slide as much as you can to the actual market.
I'm not sure who wants to field this next question, but does UK have any budgeting templates that they can use?
Yes, we have a lot of different budgeting templates that you can use. But I'll let Kitty and Greg jump in on any specifics there. But there's a lot of budgeting templates out there for just about everything. Maybe not here, but through an internet search, you can find a land grant institution that's got a budgeting template or something.
We do have a backgrounding and a stocker budget. That said, they're not the best. We really should update those at some point, but they're very basic, so they're good as a very basic start. But I would encourage people to kind of start with that and then maybe refine it based on their own experience.
We will have time for just a few more questions. So if you have those lingering thoughts, please feel free to drop those in the Q&A box or the chat box. Kenny, back to price slides. When selling, as feed costs are rising, the price slide should increase also. Is that correct?
It's probably the way that maybe they worded the question. So generally speaking, when feed costs are higher, right, that means cost of gain is higher. And that tends to make value of gain higher, which what that really means is those price slides narrow. So in a high feed cost environment, the difference in, say, a 700-pound steer and 800-pound steer is going to be a smaller difference per pound, right, than it would be in a lower feed price environment. So as feed costs go up, price slides should actually narrow.
And then the last question we have is, where would one find both full-blood Wagyu and American Wagyu market prices?
I hate to end on one I can't answer, and I apologize to the people that asked the question, but I don't know. You know, those are fairly small markets, and they're kind of unique markets, so they're not going to run through the type of market channels that we get price data for. So I guess your best bet would be find somewhere that those type of cattle move and see if you can get some sort of feel for the market in that region. I just simply don't know, and I apologize.
And I'm not 100% sure, but I would encourage you to reach out to maybe your breed association, either at the state level or the national level. They probably have very specific resources that can help you with those pricing guides and where to go to find that information. That would be a great place to start, at least with that question.
Yeah, thanks, Becky. That's excellent.
So Kenny, we've got one more that just came in before you shared the Cape code for the night. If the market goes down significantly and you have LRP, what happens if you don't sell the heifers, but you keep them as replacements?
I'll be honest with you, I don't know. I believe you would be okay, but I'm not going to say that for certain. You probably need to run that by someone who actually sells the insurance product, because in theory, what I've been told is they could ask for a bill of sale or something. So that's a good question. I would think it would be covered, but it'd be worth verifying, because I don't know for certain. Does anybody know on the panel? Because I don't know for certain.
Yeah, I'm not sure. If I was worried, though, I would literally write myself a receipt. I'm selling it for my cow-calf operation into my backgrounding. Well, I guess you're going to keep it. So, yeah, I would ask your insurance person about that.
That's effectively what you are doing, though, is selling from one enterprise to another. It's a good thought, Greg.
But my guess is, just knowing how some of those insurance, they probably wouldn't. I mean, I'd say the odds of them checking and knowing that you didn't actually sell them would be pretty low. But that said, I would check with your insurance agent.
That seems to be all the questions we have right now. Kenny, do you want to share a Cape code?
I will. Can you see it, Becky? All right, we're going to go with BACCONF, and we're going to call this one final. At least the final one for this series. So BACKCONF final. And reach out if you need that by all means. If somebody cut out, we'll get it to you. We got you. So thanks, Sarah.
Kenny, or the rest of the panel, do you all have any final closing comments from the conference before I wrap us up?
Greg or Jonathan, anything?
Other than thanks everyone for participating. This was kind of a trial run for us, and so we appreciate it. We're probably just a little bit rustier than we would in person is my guess.
No, I would just echo what Greg said. Thank you all. It's a pleasure. Thanks.
Thanks for hanging with us, and thanks to Ag Development Board funding us through the Beef Network, and thanks to Becky for putting up with 3 economists 3 nights straight.
You're very welcome. So thank you everyone for your great questions and interactions the last 3 nights. We do really appreciate it. Thank you again to the Kentucky Agriculture Development Fund, funded through the Kentucky Beef Network, for your support of these webinars and our programming that we can provide to these Kentucky cattle producers. Thank you again for joining us for the Stocker and Backgrounder Conference this week, and we hope you have a great evening. Thank you.